Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. We define insights as concepts that are counterintuitive, widely misunderstood, or underappreciated. In other words, unique ideas that you probably won't hear elsewhere. I'm Alex Shahidi, the host of the podcast and co-CIO of Evoke Advisors, a leading investment advisory firm. Learn more about our show at insightfulinvestor.org. Today's guest is Darell Krasnoff. Darell is managing partner at Evoke Advisors and one of my partners. He was a co-founder of Bel Air Investment Advisors and previously served as a managing director at Goldman Sachs, overseeing private client services for the Los Angeles office, where he began his investment career in 1981. Welcome, Darell.
Thank you, Alex. Great to be here to talk with you.
Let's start with your background. What would you say first ignited your passion for investing?
So interestingly, I'm not sure I got into the business from a passion for investing per se. It was one of the things that I found interesting. But the thing I think that brought me in was a combination of wanting to help people. That was where it started. Wanting to be an entrepreneur. And the content of investing made it particularly interesting for me. So the combination of all three of those things is what really drove me to be looking to go into wealth management. I was a econ major as an undergrad, and so I really like the macroeconomic kinds of picture and try to understand what's happening in the world. And being able to bring all that down to how does that impact people's lives day to day, and how can I help protect and grow their hard-earned wealth was a really great way to live the things that were most interesting to me. Doing it in an entrepreneurial way added an extra element that was that much more rewarding. So it was all those things together really is what got me in there. I also really like puzzle solving. There's no better big puzzle than figuring out what's happening in markets and in politics and in geopolitics, and all of it becomes super relevant to what we do for our clients. And so that has been truly fascinating. And I think I've learned to appreciate that more and more over the years.
One of the aspects of investing that I enjoy most, and I'm curious if you agree, is I feel like the learning curve is always steep. It's one of those disciplines where you can never quite master it. And you feel like you're learning as much as you can. And then you meet somebody new that opens a new door and you realize how little you know. And it's like a lifelong process.
Yeah, it keeps you humble for sure. Things are always changing too. So when you think you got something figured out, it changes. And when you are expecting reactions in a particular way and they don't happen that way, it's also hard to know, is this the exception or is this the new rule? So there's always new data coming in to try to figure out. But yeah, it's one of the great things about our business is that it's constantly changing, constantly evolving, and that you never have it figured out. I like that there's no end to that process.
You went from Stanford to Goldman Sachs Private Wealth, and you spent 17 years there before co-founding Bel Air Investment Advisors in 1998. And then later you joined us at Evoke in 2020. Would you walk us through those career transitions and what motivated each change and what you learned at each stage?
That's a big history, a lot of years. So I talked about what brought me into the business initially. And at the time, in 1981, Goldman was really the only substantial firm that did a really good job of training new hires. I'd had anywhere between 7 and 10-month training program. I was in the long end of it because I needed it. So I was back in New York for 10 months learning how to do what we do. And they did a great job. I was young. I went right from undergrad to graduate school, so I didn't have much experience. I didn't know what I didn't know yet. And I thought the best way for me to get up to speed was to have a really excellent training program. So that really got me started well. I joined a strong team, a team that I think had one of the best reputations throughout the firm at Goldman. And I'm a big believer in having mentors. My teammates were mentors, and my manager, Rich Atlas, was a terrific mentor to me. So I learned the culture and the hard work and the content of managing wealth and helping people there at Goldman. And the more I learned about the business and the further I got along my education, the more I realized that wasn't the best model for how to help individuals manage their wealth. I did spend 10 years managing at Goldman before I left to go help start Bel Air. And that was some of the most enjoyable years I had. I loved mentoring new advisors. I enjoyed hiring a lot of folks. Some of them we work with today. So that was a very special phase. And when I was ready for the next phase of taking it to the next step of being able to build a business with what we knew after, at that point, almost 20 years at Goldman Sachs, to be able to do a better job, to have fewer conflicts, to have more transparency. That was really the impetus behind starting Bel Air. At the time, Goldman really was a closed shop, meaning all of the investment results were driven by what we did internally at Goldman. And as technology evolved and it became clear that the best and brightest weren't all in one place, that was no longer the model that would serve our clients best. And we tried to get Goldman to be willing to let us find third-party managers to execute, particularly on the private side. And that just wasn't in their DNA at the time. They have since actually evolved to do that, but at that point, they weren't willing to do that. So we left to go do what we thought was best for our clients, which was to have an open architecture kind of a platform where we could find the best and brightest anywhere in the world to be able to deploy to serve our clients and their investments. We built that for a number of years, sold it, bought it back, sold it. We had the idea that we knew what we were doing and we could build it on a national basis and sought partners to help us do that. For many reasons, those transactions turned out not to get us to where we wanted to go. We learned a lot about the right kinds of partnerships through that process, who can be well aligned for that goal and who wasn't. And after a couple of attempts, it became clear that the future of that firm was going to be different than where my teammates and I wanted to go. But we learned a lot at Bel Air and very proud of all that Bel Air has accomplished, and still Bel Air is a great firm. But for our team, we were ready for the next step, which was we wanted to, again, become more entrepreneurial, bring even further objectivity. In the Bel Air years, we were a broker-dealer, and we also had some product that we managed internally. And we felt that the next phase that we wanted to do in the business was to be completely open architecture and independent and not have internal products where we generated some additional income for having those products in-house. And interestingly, at Evoke, as you well know, Evoke does do a few things internally, but it was very thoughtful in developing a way to make it completely transparent and objective, where there was no additional compensation that Evoke would earn by doing things that we had some unique capabilities to do in-house. And so I was very happy that we were able to, at Evoke, get to the ultimate stage, I think, which is of having complete independence, transparency, objectivity, being of service to the client, putting the client in a position where they were at the center and everything we do evolves around client needs and not our compensation. So it's been wonderful. It's been over 5 years that my team and I joined Evoke from early years of Evoke. It's been very satisfying to work with folks that I have a lot of respect for in a structure that we think gives us the optimum approach to help clients. And here it is now, I think 44 years from when I started at Goldman, still loving what we do day by day and still feel inspired to come and help our clients to meet their personal financial goals.
That's great. And it's been your sole career since you graduated school. So there's obviously something there that keeps you here.
The younger folks that I talk with these days that look to how do you advance in your career by jumping from place to place and doing different things, it's pretty phenomenal to think about that I've been doing effectively the same thing with some of the same clients from day one, or in some cases, the children or grandchildren of those clients. But I look back and think I was very fortunate to have found this, for it to be this fulfilling and this interesting for this long.
What aspects of being an advisor do you most enjoy, and what do you find most challenging?
It still comes down to the relationship I have with the people that we serve, our clients. I just had a conversation this morning with a client who said, look, we trust you completely. We know you're watching out for us, and it allows us to do the things we like to do in our lives. And that means everything to me. The satisfaction of doing what it takes to help clients live lives that are meaningful, purposeful, enjoyable, knowing that we're taking care of something that is critical to their well-being. And so that's at the heart of it. All the rest is about how do we do it? And I enjoy, as I said earlier, the puzzle solving and trying to figure it all out. But if it was just that and it wasn't working with amazing people and feeling like what we do matters in the quality of their lives, it wouldn't have been enough to keep me going for 44 years.
It is fascinating when you talk to people who have been successful in all facets of life. You learn a lot from them.
I'm very fortunate. I feel this way all the time, to be able to have relationships with some remarkable, talented, successful, high-quality people. One of the things that I've learned over the years, actually, is that not every client is the right client. There have been clients that I have had to part with over the years because it didn't feel that way. And you can't do that early in your career. Early in your career, you are seeking to do business with anybody that you can because you're trying to build a business. But as you get a little bit further along and have some choices, making choices about who you work with, both your internal partners and your clients, really is a tremendous benefit to the quality of life when you feel able to make those choices. So I feel privileged that I've been able to do that over my career, and I truly enjoy the clients that I work with. I don't want to miss the negative part when you ask something about what are the challenges I've experienced. And I think the biggest challenge is that we can't control markets. And sometimes I have to bring bad news to people about what's happening in their assets.
They're also hard to predict.
And it's hard to predict. So you want to be able to always bring good news, and you can't always bring good news. And some clients understand that, some less so. And over the years, I think our clients have learned very well how to be patient and take a long-term view. Certainly folks who have been with me for a long time understand that. But there are times where it's just really painful to bring some bad news about near-term changes in value. And I feel responsible for it, even though it's not in my control. So that's the hardest part. Fortunately, those periods tend to be shorter lived than the good periods. We've been on a long positive run, although we've certainly had some very sharp and painful declines along the way. But if clients build their portfolios with us in a way that leaves enough buffer, it doesn't need to affect the quality of life. It affects the emotions of what it feels like day to day to go through hard markets. But as long as we have built the portfolios correctly, which I think we have over the decades, that we come out the other side and we're okay. But it's hard to go through.
When you look back on your career so far, are there any big decisions or moments that you now see as pivotal or formative?
One of the biggest decisions was the decision to leave Goldman. Goldman was a tremendous firm. I had a lot of respect and admiration for my colleagues there. It was the formative place that I had learned the business. As the office manager, part of my job was to keep people from leaving. In fact, I was the office manager when some of the folks at Evoke left. So that was a hard decision to make. I felt like I had a lot that I felt grateful to for Goldman, and I felt like I had given a lot to Goldman, but it was hard to make a choice to leave. And yet, leaving with my partners and knowing that we were doing the right thing for clients made it something that felt compelling to do. But it was a real test. There was a lore at Goldman that nobody succeeds after they leave Goldman. And that was just something they told people at Goldman to keep people from leaving. It was a bit of a fallacy, but still you kind of buy that while you're there. And so it's a big risk you feel like you're taking. But we had the confidence that we knew what we were doing, that we believed in each other, and we believed we were doing it for the right reasons. So that was a major shift in my career to become more of an entrepreneur. I always enjoyed the entrepreneurial aspect of wealth management, that you built the business inside. I used to call it that we were a chicken entrepreneur. We had this brand that we were out representing, and so it brought credibility and allowed us to build a business. And what's harder is to do that based on you and your partners as individuals, to go out and build a business that you feel proud of and that you build your reputation one day at a time. And then you look back and you realize that we've done something well over these years. But until you do it, it's hard to believe that you can do it when you've been relying on the mothership to bring that credibility to you. So we took that leap, and it's been a wonderful second half of my career. It's been about almost 20 years on each side, stepping out of being a chicken entrepreneur to a real entrepreneur. And so that's been a wonderful change that took a lot to make that jump.
Within your 44 years, you've been involved in the investment advisory industry, and you've obviously overseen the asset management industry as well. And so I'd like to delve into that a little bit for our listeners to hear some of your insights. So would you start with a high-level overview of the investment advisory industry today and share your views on its current direction?
Yeah, so things have changed a lot over these 40 plus years. When I started in the business, we were brokers. There was no fee-based aspect, certainly not to Goldman. There may have been some small RIAs at the time, but we've evolved to having many channels of how people can get financial services, starting with the big wirehouse firms, the Goldmans and Merrills and JP Morgans of the world. I've never really known why they were called wirehouses. And I looked up before coming here because I thought, well, if I'm going to mention wirehouses, I should know what they are, because we all just know who they are, but we don't know why they are. It turns out that in the early days, trades were entered using wire, Morse code, and sending direct communications to trades. That as national businesses developed, trades were all done in New York. And the only way to get the orders in was by wire. And then they became telephones and then digital connections, but they're still called wirehouses, any of the national footprint brokerage firms. These days also, there's a lot more do-it-yourself. When I first started in the business, there weren't ETFs. My 18-year-old son teases me from time to time when we talk about what things were like when I was in the business. I have to tell him, well, they did have fire and we did have cars and color TV, but we didn't have computers. And computers have changed everything in the world, but certainly the financial industry, which allowed for a proliferation of products and of platforms and of things you could do yourself, and even data that our clients didn't have really any clear information about what was happening in markets unless we shared it with them. And now there's 24/7 cable news, and you can get anything on your phone. And so I think that advice has become even more important. The more information is out there, it's just more noise and confusion. So many different people telling you what to do and how to do it and why to do it. One of the fastest growing segments in wealth management today is the registered investment advisor. Because of technology, we're now able to do a lot more outside of the big box wirehouses. It used to be that if you weren't at a major firm, you didn't really have access to the kind of research or trade execution that you needed in order to do good work for people. And now information is everywhere. And so that's not the obstacle to getting good results. It's really the quality of the people that are making decisions and the structure of organizations that put themselves in a position where they're truly client-focused. And so the big broker-dealers tend to have their own products, and a lot of what they do is in-house and internal, and there's different fee or revenue sources depending on what clients do, which is what we wanted to get away from when we left Goldman. There never used to be the discount brokerage. When I first started in the business, the transaction costs were pretty well set. There was a formula, and you'd look it up on a table, and it would set the cents per share commissions, and that all went away. And then discount brokerage came in, which allowed for much more active trading, and that facilitated ultimately ETFs and mutual funds and all the like. So now there's a wide range of capabilities and channels that clients can access. But again, I think that what matters most is where you can get reliable, objective advice, because in this environment of proliferated products and ideas and solutions, having access to unbiased advice becomes more and more important.
Is your experience that the industry has slowly evolved from sales to advice?
So it was transactional when I first started. You would come up with a good idea, somebody would act on it, and you get paid. So now, more and more, there's no commissions at firms like Fidelity and Schwab. You don't generate any commissions for transactions. So if you're not bringing value add by your ideas, by the advice, and I don't think it's as much advice on a given stock, it's really advice on how to build portfolios. So it comes back to more of the macro. With the proliferation of high quality ETFs and very tax beneficial ETFs, even owning equities is becoming more commoditized. There's less value add by what an advisor can bring in equities. There's still markets that I think are inefficient, and it's only inefficiencies that bring potential for alpha. And so probably a small cap and emerging market and perhaps international are still places where there's the opportunity for managers to add alpha by their decision making. But otherwise, using ETFs is going to be hard to beat. The value add that a client is willing to pay for is much more in the macro issues, and even includes tax and estate planning and building diversified portfolios that protect against all kinds of market environments and generates enough cash flow and balances liquidity and the lack of liquidity. And there's still an area that I think is probably highly differentiated, which is in the area of private investments. And so that category is one where I think there is a big spread between the median and the top quartile, and even between top quartile and the top decile. That's an area where there's high value added to expertise and access. That's an area where it still makes sense to invest a lot in diligence and research and accessibility, which makes up for the more commoditized nature of public markets. But broadly, absolutely, that it's advice that has value now, not transactions.
So Darell, if you were king for a day and you could redesign the ideal wealth management firm from scratch, what would its structure, incentives, and client priorities look like?
So I'd have to be king for longer than a day. The priorities, I think, are to be completely objective and transparent, to have very capable in-house research insights and expertise, having enough people to cover the field, particularly around privates, to be able to access privates. The other thing that's very challenging is it takes enough capital. It's hard to design from the get-go because you can have a plan, but you can't execute it without enough critical mass in the business. And there's great value to having experts that are friends of the firm. You've been interviewing a number of them here on your podcasts, but we have access to some of the best and brightest in the world at investing to help us to develop our perspective about what's happening in markets and themes and opportunities. I think having that aspect, I had underappreciated the value of that. But in general, having enough critical mass to have the scale to be able to have all of the areas of expertise inside the firm, I think there's been more and more appreciation of the value of handling all of the financial needs of a client. And that's tax returns, and if they need it, bill pay and financial statements. And there's virtue to having all that available to the extent it's needed. So that's an element. I'd have things like trust services so that we can work with clients beyond their lifetimes and help their children and grandchildren through having that trust capability.
I guess another way to ask the same question is, if you were the client, knowing what you know about the industry, what would you want? What I've learned through time is as our lives have become more complicated, especially as you gain wealth, things get more difficult in some ways. Some things get easier, some things get more difficult. It is helpful to have a place you can go to that you trust where you are able to offload a lot of that, and it helps simplify your life. The one thing that wealth can't buy is time, and time becomes so valuable.
Mm-hmm. Yeah, well said. Trust is at the center, obviously, of the client relationship. If you think about everything that we do has to be thoughtful about, will this enhance the trust clients have, not only in our doing the right thing, but our having the capability of doing the right thing. So at both levels, trust is the critical driver.
When you're advising clients, what do you think you are ultimately optimizing for? Is it risk-adjusted returns? Is it peace of mind? Is it tax efficiency? Or is it something else?
It's an interesting question, and that's changed for me over my career. In the early years, what mattered most to me was delivering results. I just wanted to get good performance. And I felt like each quarter, my report card was the performance metrics on the reports that we were giving to clients. And I wanted to be able to show that I'm outperforming, and that even a few basis points, you could feel great pride on a net of fee basis outperforming. I still want to outperform net of fee, but I realized over the years that what I think matters most is how it impacts clients' lives. Are we helping them to live the lives that they want to live? If I get a great rate of return, but the client had anxiety over the course of the year or 2 years or 5 years that I'm helping them, then I've failed. So it's really about making sure that the client is meeting their goals. And sometimes those goals are financial, sometimes they're otherwise. But money, the net worth, and even availability of capital, you can have a lot of money but don't have liquidity, and that creates anxiety too. So it's really taking care of making sure the client's needs are getting met and the results are working for their lives. And a big part of now what we do is to help clients determine that. If we're doing our jobs, a big part of the conversation is, what does it take to make your life work? What's the income you need? How important is it to double your money versus to protect your money? And so there's a lot of risk assessment and cash flow assessment, and even issues of, what do you want your kids and grandkids to have? What's your interest in philanthropy? How do we help optimize all of that in a way that meets the quality of life and purpose-driven goals of our clients? And money, it becomes, when you look at it that way, it's a means to an end. It's not the in and of itself.
One of the ways I think about it is, one of my main goals is to minimize negative surprises. And that comes across both in how you give advice and also the education process to help people become better informed about what the range of potential outcomes is. And I just think of it as, I just want to minimize those negative surprises. If there's very few of those and far between, then I've probably done a decent job.
Yeah, a good point.
How do you think about firm size? We're talking about building an organization to serve clients well. How do you think about large firms, small firms, in between? What impact does that have?
So earlier I talked about critical mass. So you need to have enough assets that you can build out the people inside an organization, that you can meet all of the clients' needs and be able to do a good job of diligence and research. So that requires more than a couple billion of AUM. You think as you get up into the 10 billion plus, that you've met critical mass needs. And then on the other end, it's, you want to not be so big that it's hard to access the boutique investment managers. That when you think about the relationship between size and alpha, there are some markets that can take all the money that you want to invest in them, but many markets, that's not going to work. That smaller scale managers that have 500 million or maybe up to 2 billion, that there are certain markets and certain kinds of investments that just don't work at large scale. And so if you're too large, you have to ration those across your clients in a way that not all the clients are going to get access to your best ideas. And then firms that are too large also, by nature, they have to become less customized. You can have any color you want as long as it's white. There's also kind of a institutional morass that develops of being creative and getting things done. One of the things that, again, this is not as an advertisement, but just as the people, one of the things I always admired about Mark and David when I watched their careers over the years is they were always willing to try new things and be entrepreneurial. That, I think, is a really important quality to a successful firm, is being willing to try new things and be open-minded and adaptive. If you're too big, it's really hard to do that. If you're too big, you can't really encourage your clients to all reduce equity exposure because the markets won't absorb it to all sell at the same time. I don't know exactly what number is too big, but there are firms out there that are too big to be able to bring custom boutique solutions to their clients. I do think size matters.
So you've been a financial advisor for 44 years. You've also managed a lot of successful financial advisors. What qualities do you believe are essential for someone to excel as a financial advisor today?
Back when I started, people had to be generalists and be effective at everything. I think the world is much too complicated for one person to know all that they need to know. And so there's now room for specialization. So there can be people who are focused just on a narrow part of the wealth management industry or strategies. I don't think you just have to know everything. I think you have to still be very bright and curious and knowledgeable, at least willing to learn, depending on where you are in your career. So capacity for learning, willingness to have an open mind and not think you know everything. It's one of the great pitfalls in wealth management, and probably in any part of life, is thinking you know more than you do, because you're going to make mistakes that way that are significant. So understanding what you don't know, being willing to ask for help when you need help, so being humble. This is not an easy business to build and grow as an entrepreneur, and so you have to have a tremendous amount of drive. Something has to be compelling you forward to keep working hard, to do more than most people are willing to do. And it's an industry where there's great reward for hard work, but you got to put in the work. And I think, coming back to your question about you get paid for advice, you also have to be able to work with people or enjoy people, care about people, have a lot of empathy for what people are going through and what they need, and caring about being of service to them. That has to be, I think, an important part of where you get your satisfaction. And then I think you need a certain level of math skills. I don't think you have to be a PhD, but the way I describe it to people is numbers have to mean something to you. There are people who can do a lot of calculations, but the numbers don't actually speak to them. They don't mean something. Our world, numbers represent things that are actually real in the world. And so you need to be able to make those connections and have them be intuitive so that you can make good judgments based on data and personalities. That's the combination, really, of assessing data and assessing personalities and then making good judgments about them all. Integrity has got to be number one overall. This is a business built on trust, internally among partners, externally among clients, having integrity. And that's the hardest one. You don't know that somebody doesn't have integrity until you learn that. But there are tales, and you can infer integrity from getting to know somebody and what their values are about whether they live a life with integrity at the center.
How much of the formula for success do you feel is IQ versus EQ?
There's a necessary level of IQ, but it's not probably as high as the necessary level of EQ. If you didn't have enough IQ, no matter how much EQ you have, you're not going to be able to help people. But if you have a very, very high IQ and not very good EQ, you're not in the right business. There needs to be sufficient levels of both, but if I was going to have higher of one, I'd take the EQ.
Yeah, it is interesting because if you look at it from the outside, you would think the answer is IQ because you're hiring somebody that has expertise in the financial realm. But so much of it is relationship building, trust building, communicating complex concepts. And a lot of it is driven by emotion because you're dealing with people's money.
And there's so much expertise out in the world that you can harness to generate attractive returns for clients. You don't have to have that all in-house. That you just have to be able to find it. So you don't have to be the smartest person in the world to be able to find the smartest person in the world.
So we talked about viewing the world through the eyes of the advisor. Let's go to the other side of the table. Are there common blind spots or misconceptions you see among clients? And how do you help them address these?
I think one of the areas that are hard for clients to develop is a trust that financial markets actually make sense.
Sometimes they don't seem to.
Sometimes I don't. Even these days, it may be too good to be true right now. That it's not just a casino. When you've built a business day by day and build great value, bringing value to your customers, and you achieve a certain amount of net worth, it's scary to go from having something you have direct control over to something that you feel is a bit random or certainly opaque about why things happen the way they happen, why it goes up, why it goes down. So I think it takes some education and some time for people to understand the correlation between things like population and productivity and the amount of money in circulation and how that drives value over time, and being able to trust owning businesses that you don't control and that you have all of the net worth that you've built over your life and have that exposed. And it's hard to do just on the trust. The advisor knows what they're doing. So I think being able to help educate people on how markets work, why they go up or down, why they go up over time, and to be able to trust that your net worth is okay. If you put all your money in cash, you over time have lost money relative to inflation. So if you don't take any risk, you're guaranteed to lose money on a real basis. It's how do you take smart risk, and what does that really mean, and how do we educate people about what risk is worth taking? The other side of that is there are some people who are biased towards just putting it all at risk, and that we need to slow down a little bit. They've seen people make unusual amounts of wealth by taking big risks, whether it's early in the crypto environment or early in AI, and you have a home run. And one of the things that we spend a lot of time talking about with people is what's the utility of making more money relative to the pain of losing money? Do you have enough to make your life work where you're at, or should you take a risk beyond what's a reasonable risk to generate the cash flow and keep up with inflation in order to double or triple your money? And people at different phases of their life have different answers to that, and we help them based on whatever that answer actually is. But that's an important part of it also, is to help educate people about where not to take risk and where risk isn't useful to you because you already have enough. Why risk going backwards in order to double or triple when life is working just fine as it is? So I think both of those are things that we've helped clients to understand better over the years.
One other element that I find interesting is investing well requires patience. And patience is a little bit different. The timeline is different in the investment world than it is in most of the world, where a year or 3 years or even 5 years is a short period of time. Whereas everywhere else, that feels like a long period of time. And that disconnect can make it challenging in practice.
Yeah, that's a very good point. It's investment cycles. When we meet with people that talk about that they're looking for results, then they might need to use the money a year, 2 years from now. We encourage them not to own any stocks. You have to have at least a 3 to 5 year time horizon before it makes sense to own any stocks, because there's no certainty about what will happen in the short runs. I still remember a analysis that I saw about the relative importance of individual stocks versus markets over time, and that the market defined 70%, I think, of the result of an individual stock in a 1 year period. And over a 5 year period, it was like 30% of the coefficient of contribution to the total return by markets versus the individual fundamentals of the company. So the longer you have, the more likely you're going to get the results you expect, but you need to have that time.
Let's transition to talking about the asset management industry. So we talked about the financial advisory or investment advisory industry that you and I are working in, but the asset management industry where you have money managers. Would you help our listeners understand how the asset management industry fits into the broader financial ecosystem, and also how incentives are typically aligned and what might surprise clients about how the industry works?
So when you talk about asset management, we're talking about now mutual funds are an asset that is managed. Separately managed accounts get managed. Certainly all the fixed income strategies. So there are large successful firms that don't work directly with clients, but just manage assets internally. Some of them specialize, and some of them are quite across all of the asset classes. Most of them work on a fee for management. Some work based on performance. So if you're into looking at things like hedge funds, private equity funds, real estate funds, all the funds tend to be management fee plus a percent of return. So in those cases, the incentives are more aligned. If they do really well for people, they get paid more. Something to watch out for is that there are some kinds of hedge funds, for example, where they're effectively giving you market-based returns, but charging performance fees on them, and that there's not enough value add to justify paying a performance fee. There are some managers, it's very hard, for example, for domestic large cap equity managers to justify the fees they charge at all, because the average manager in that category underperforms net of fee. It's important to, if you're going to be paying fees, because the industry is set up where they make money based on the amount of assets they manage typically. And again, earlier I had mentioned that in some ways, size is the killer of alpha. And so they're incentivized to have more and more and more assets under management. That may not help you as the client to get better returns, but it makes them more money. So you have to be careful as the client about the size of the asset manager out there and whether they're truly adding enough value to justify their fees. And that, I think, tends to be more an issue with, again, domestic large cap or large cap in general. But where it comes to smaller, more boutique, more focused managers, it's one of the things that people should evaluate. Is there enough return to justify the fee? And so would tend to look at something like rolling 3-year histories. Every manager underperforms for periods of time. You could have 6 months, a year, 2 years. The best of managers, I remember when people thought Warren Buffett was no longer smart because he had, I think, 2 years of underperformance when what he did was out of style. Even in this environment where markets are being led by the Magnificent Seven, that's not necessarily Buffett-esque, although he does have some meaningful exposure. But anybody can be out of style for a couple of years, so you've got to look over longer periods to see if the fees are justified. I like investing where we're aligned, where it's not just the size of assets under management that firms are getting success on, but the results they can create. Again, that happens much more in the alternative investment category, particularly in structures like hedge funds and private committed and drawdown funds.
I like to oftentimes try to simplify things. And one of the simple questions I ask myself when I'm talking to an asset manager is, what business are they in? Are they in the business of gathering assets and trying to maximize the profits? Or in the business of generating returns for their clients? And I think of it as a spectrum. On one end, you have asset gatherers, and on the other end, you have return generators. And everybody's probably somewhere along that spectrum. But I think if you simplified, you could try to distill what business are they really in, and you have to go beyond what they say. You have to follow their actions.
And it also helps to see that they have a lot of skin in the game, that their money is invested in the strategy that they are looking to encourage you to invest in with them. And many managers don't have a lot of their personal money in their strategies. Some do. And so that's also something that is compelling.
You've spoken quite a bit about the potential impact of artificial intelligence on investing in our industry. How do you see AI shaping the industry in the coming years?
That's a tough one. I had listened to a conference recently where I thought one of the wiser things I heard was that people are fearful that AI is going to take their jobs. And the comment that this person made is that AI is not likely to take your job, but somebody who's using AI better than you probably will. So I think we have to be very open and curious and engaged with watching the path of what AI is enabling and make sure that we're harnessing that capability and bringing it to clients. We already are. There's already tremendous amount of research you can do with AI that shortens the process of digging in on fundamentals of businesses. All the data is readily available, and ChatGPT, Claude do a great job of assembling that data. We're using it internally to help be more efficient. We're now taking notes on Zooms and integrating that into Salesforce and having that help us stay on top of our client communications. So there's a lot of productivity enhancing AI. At some point, probably in the not so distant future, there's going to be more and more investment advice coming from AI. There already are, I know, platforms that are relying on AI to help the $1 to $10 million clients invest their money more efficiently. We've already seen the robo-advisor platforms that are doing tax harvesting and giving asset allocation advice. I have experienced by playing around a lot with things like ChatGPT that there's a lot of errors in the advice that it gives. So you have to be super careful that you don't just take what AI tells you. A funny story about that is I have a 31-year-old that we were looking for a place to go to dinner to celebrate with 12 people. And I asked ChatGPT for recommendations in a particular geography. He happens to be a chef. And so we wanted a restaurant that would be a good place for a chef. They would deliver some really good food. And it gave me a list and it had 3 top recommendations. And when I went to each of the 3 to see if they had reservations, 2 out of the 3 had been closed for over 2 years. And when I went back to ChatGPT and said, by the way, this restaurant and that restaurant is closed, and it said, you're right, here's 2 more ideas. And so that was a kind of a benign issue, but I had the same kinds of things about tax rates and after-tax returns when trying to build models and understanding whether the ACA was relevant to a client for their after-tax returns. And so they're not reliable yet, but they're helpful. We will continue to watch. But coming back to your earlier comment about advice, I think AI is going to make us smarter, make us have access to better data and be able to be more efficient. And I think for the smaller, the 1 to 10, I think it's going to allow them to serve more clients. They'll be able to do things more efficiently across the client base. Perhaps it will allow you to do analysis that you weren't able to do before in terms of projections, pro formas, building a lot of variables into models that might have taken 2 days to do, it can do in 10 minutes. So there's a lot of benefit from it. But I am just watching now a robotic food delivery going up the sidewalk. You don't know what it's going to be able to bring 5 years from now or 2 years from now as it keeps getting better and we figure out more and more ways to deploy it. And there are more effective apps that are taking all of our cumulative knowledge and making it available at our fingertips. So I think there are going to be ways that will surprise us all. Certainly nobody would have anticipated that we'd be using Airbnbs and getting rides from Uber before we had mobile communications. So I think we'll have to still figure out what other ways it's going to impact us, but I think you got to be on top of it, and it's going to certainly change what we do. You want to be riding that wave, not getting crushed by it.
And going back to the question I asked you earlier about IQ and EQ. So it may help you with the IQ side, but the EQ still needs a lot of work.
Yeah, unless it becomes your therapist, and then maybe it can help you, but that's a different aspect.
Well, you've been involved in leadership for almost 40 years. How would you describe your leadership style?
I had once had a professor from UCLA come in to talk to people about leadership. The thing I remember most that he said is, if you don't know your leadership style, you don't have one. I don't think a lot about it, but just watching what I do, and something that was clear to me early is that for me, leadership is being of service. I think in the early years, you think about being a leader as a big ego thing, that you're an important person and you have an important role, and that to be a good leader, you're a person who is facilitating others to do their jobs well. In sports, I was always the guy that I was an offensive lineman in high school, so I was opening the holes for the guys that got the glory. And in rugby, I would get the ball out of the scrum and get it to the backs so they can go score. And I think that's probably how my leadership is shaped, is that my job is to facilitate, to make sure that everybody has the skills they need, the tools they need, the resources they need to be successful, and then to hopefully set a good example. When I was running the office at Goldman, my goal was to have all of the newer advisors come out and do meetings with me, and that for the first few weeks, they would learn from what I did, and then they would do it themselves, and then they would get even better than I ever was. I try to lead by example and be of service, and to get my satisfaction out of the success of the people that I've been entrusted to lead, so that my celebration is their success, not my success.
You've consistently identified and hired exceptional talent throughout your career. What do you look for when evaluating potential partners or employees?
So it's been some of the most fun I've had. As I was talking just a minute ago about the celebration I get out of seeing people successful. So what's interesting is that the people I've hired over the years, it's a pretty eclectic group in terms of what their backgrounds have been. I'd hired a zoologist and a PhD in chemistry, also a lot of MBAs. But the things that I think were most compelling to me were, number one is character, who they are, how they live their lives. I mentioned integrity was at the heart of being a successful advisor. So character is probably number one. Drive, number two. Talking about continuums, there are some people who are very happy just not doing that much and being satisfied that their lives are fulfilling without pushing that hard, because pushing takes work and they'd rather focus that energy somewhere else. And I've looked for the people who really desire to excel and thrive and accomplish a lot, and that also have some insight about why that matters to them. I tend to ask a lot of questions about what are the motivations, not just what are you doing, but why are you doing it, the why questions. So I want to really understand what drives people. And I'm looking for people who feel compelled to do the best they can, that it matters to them, that that's where their satisfaction and purpose is contributing as much as they possibly can. And in this case, it means building a big business or a successful business. So character, drive, they have to be somebody that has a personality that you enjoy being with. One of my colleagues over the years described that it needs to be somebody that you could be in a snowstorm in, I think it was Hibbing, Minnesota for 3 days, and you'd be okay, just the two of you sitting through the snowstorm. If they're not likable, then our clients aren't going to find them very likable either. Now, there's a wide range of it. It's not somebody that necessarily has to fit my definition of what a likable person is, but across a group, they have to be likable by enough people that A, you're going to want to work side by side with them, and B, clients are going to like them. And three, I think, or four, maybe now we're up to, they have to have demonstrated enough commitment and stick-to-itiveness to get through the hard times and get to good outcomes. It's a very daunting process to build a business from scratch or to learn this business from scratch. And if you are easily deterred, you're not going to get to the place of success. People, by the time we meet them, have to have shown that somewhere in their lives, whether that is in their sport or in their instrument or in their poetry or in their military service and the rank they got to. There's lots of evidence of people's commitment to get to a good outcome. That's, I think, a vital aspect of it as well. And then enough intelligence, but again, and an EQ, but those are kind of the starters. Everything else has to be there for, in my view, somebody to be destined to success in this business.
Is there a leadership insight that you feel is counterintuitive or not widely appreciated that you'd like to share?
Well, I talked about leadership as service. I'm not sure that that's how everybody thinks about it. My mentor, Rich Atlas, had said to me, there's two ways to lead. One is because of the chair you're in, the role you have been put in. And the other is through earning it, through people wanting to follow you because they believe that you have value that will help them in their careers or on their path. So for me, it was much more that second part, that you had to earn the privilege to lead through how you've conducted yourself and whatever success you've achieved and what you can bring to help others.
You have to earn it and keep it.
Yeah. And it's easy to get distorted when you're given power or taken power or however you got there. And it's really important not to let it distort you, to maintain your humility. 44 years into the business, as we talked about earlier, we're still learning. I find young people all the time that can teach me something that I didn't know. So just staying humble and staying within yourself, of doing the things that you know and not stepping outside of. It's important, by the way, to step out of your comfort zone. I don't mean never to push yourself, because the first meeting I had when I was named the office manager in LA, I stood up in front of the group and I had a holy shit moment. What am I going to do now? Anything in life that is growing and expanding, you should be a little uncomfortable. And if you're just always in your comfort zone, then you're not taking enough challenges in your life and your career. But you got to know what amount you can reach to and do it responsibly. You don't want to put yourself in a position where you're going to harm yourself or others because you were unrealistic about what you really were capable of doing. So there's a balance between those two things.
I want to close our conversation by asking a few questions about investing, which you've been doing for several decades. How would you articulate your overall investment philosophy?
So you talked about patience. And so one of the things that I think is important in investment philosophy is that you want to, for me, I develop strategies that work over time. So I'm not looking to do short-term trading. I'm not looking to get excited about the rate of returns over a quarter or two. So everything is based on taking a long amount of time. And then behind that is diversification as the key to protecting wealth. Our clients largely got to where they are because of concentration, that if you want to create wealth, you got to be highly concentrated and put a tremendous amount of effort and have some good luck as well as good judgment to get to good outcomes. But once you've achieved that, then diversification is the key to preserving wealth. So that's at the heart of, well, I think long-term investment strategies is a good amount of diversification. I believe in balance between liquidity and lack of liquidity. You can get higher returns by less liquid investments, but if you get out of balance, you are not going to be in position to be able to have flexibility to make adjustments over time. So you have to have a certain amount of flexibility in the portfolio. And I do believe that smart people doing disciplined things can generate better results in some categories. Not in all categories, but in some categories. So I believe that there is a return on investment in finding very smart, very disciplined, very experienced people who can generate alpha over time through continuing to do what they've done in the past. And then where there's not a sufficient opportunity to generate alpha, then I think keep costs down and use the most efficient, tax efficient and cost efficient tools. So there's a role for ETFs in that as well. And I do believe that investing benefits from the rising tide, that over time, productivity and population growth lead to positive returns, and that if you can be patient and thoughtful about how you invest, that I've often described it as you are the casino as opposed to you're in the casino. The longer time you have, the more certain you are that you're going to make money.
Looking ahead, what major investment themes or forces do you expect to shape the next decade?
Well, we talked about AI earlier, so clearly AI is going to be a huge factor in winners and losers. We've had clients recently who've asked us to look at what industries are most vulnerable to be disrupted by AI and what are the most opportune to benefit from it. So there's going to be a lot that plays out over the next 10 years with that. From a geopolitical point of view, there's been major change in the last few years. has probably accelerated in the last 6 months in terms of realignment in the world of trading partners and friends and foes. I think there's going to be a lot of that continues to play out over the next decade, and that will have implications on a very grand scale. I think the amount of debt in the world is going to have implications over the next 10 years. Clearly, the U.S. debt is growing and may become a problem. Doesn't necessarily impact near-term investments. These long-term problems don't tend to get discounted in financial markets in the near term, but eventually we get to the long term. And so at some point it does become a problem. And it's always possible that things that need to change in order to make it not be the problem that it could be as we're heading down a path. So you want to leave room for that. But I think there are going to be some big challenges with the amount of debt in the hands of governments, particularly in the U.S., as we've been growing our debt much more rapidly. Those are some of the big themes that I see over the next decade.
How do you personally stay sharp and adapt your thinking and avoid complacency?
So I've talked a lot about staying humble. So part of it is just recognizing that we don't know all that we need to know. I have a natural curiosity and want to learn. So I think holding on to that curiosity and making sure that you're learning something new all the time, trying new things. It's easy to get stuck in certain patterns. My partner, Andrew, used to talk about his father-in-law, who, as he was aging, would take different paths purposefully each day while getting to wherever he needed to go. I drive the same route every day to and from the office. Sometimes just changing up little things makes a difference. I had the same workout for about 20 years. I did the same series of exercises, which I know is not the best for us. And I've just recently made a change so that I'm going to now throw in different things each time. Being willing to change things up, sometimes intentionally, I think is important to stay sharp. Also, frankly, being surrounded by younger people. I learn a lot from the youngest folks in the office and from my kids, and being open to learning that way, I think, is very important. It's an attitude of being willing to keep your mind open and your curiosity high and stay humble.
Well, Darell, this has been great. I appreciate you sharing all your insights, all your experience with me and our audience. Thank you.
Thank you, Alex. It's a pleasure to talk with you. We work together day by day. We don't often get this kind of quality time just to sit down and explore things together. And you've asked some great questions that made me think deeply about things that I haven't often thought about. So I appreciate that. Thank you.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke Advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke Advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke Advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke Advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.